Can you tell us what was the outcome of this portfolio in last 5 6 months?
Even though the Nifty is actually negative, I think 15th June is when we have looked at the data. So that's around nearly 5.5 months. We are happy and we are also lucky that our portfolios are not negative. And the beauty of the construct is that
Can you take us through the model portfolio and show us
we built three portfolios as we discussed, so you have a conservative, moderate, and an aggressive portfolio. So if you can see,
if someone wants to start with mutual fund investments? So, other than, before looking at what scheme to invest in, what is that one has to keep in mind?
but any investment, what you need to look at is that
Welcome to the investing mindset. When it comes to investing, most people spend their time looking for the next winning stock or fund. But what if the bigger question isn't what to buy, but how to build a portfolio that can handle different market conditions? Let's discuss this with Juzer, director at Ventura, and who heads alternate investments for more than 2 decades now. Hi, Juzer. Glad to have you here.
hello Harshlata.
I understand that at the end of December 2025, you built a model portfolios, and it was also published in Economic Times on 1st of January 2026. So, can you take us through the portfolio construct?
Yeah, so what happened is that end of December, in fact, beginning of December, Economic Times did approach us and they wanted a model portfolio, basically looking at a conservative investor, a moderate investor, and an aggressive investor. So they wanted us to construct something and give something which they can actually, publish. So based on that is basically we created, three model portfolios. First one was a conservative. So we basically looked at more on the asset allocation part first. So we had a nearly around 47% allocation towards equity. Around 38 odd percentage was towards debt. However, we ensured that the entire construct was more using multi-asset as an asset class, and we had around 10-15% exposure to gold and silver. For a moderate investor, what we thought is that basically around 60% is the exposure which would be towards equity. And out of that, around 15% exposure we also took to international equity funds. 15% exposure would be towards debt. But again, we use multi-asset as a vehicle. And again, another 15% was gold and silver. For an aggressive investor, what we looked at is a 80% equity with a 65-15% towards domestic and international, and 20% was towards gold and silver. So that is how we actually constructed the portfolio and which we gave it to them.
Can you take us through the model portfolio and show us, what is the outcome of it in last 5 6 months?
Yeah, so I think we are lucky also, and there has been a lot of events after that. So we did not know that you would have the West Asia crisis. So we started having that at 28th Feb. But what was the heartening part of the entire thing was that I think the asset allocation model basically also helps you in terms of reducing the volatility. As you can see, we built three portfolios as we discussed. So you have a conservative, moderate, and an aggressive portfolio. So if you can see, we have the data for nearly around 5.5 months now. We have captured from 1st Jan 26 to 15th of June. The conservative portfolio is now up 2.2%. So there's a 22,000 rupees gain. It's a model portfolio of 10 lakhs. In case of the moderate portfolio, it is up by around 43,000. So it's up by around 4.3%. And as regards the aggressive is concerned, it is up by around 75,000. So it's around 7.5%. And as you can see, the Nifty is down by nearly around 9%, 8.7 to be exact. Now, if you see the 2025, right? I mean, because obviously this is a very short period of 26. So here also we have taken the data from 1st of March 25 till 15th of June. The conservative portfolio is up nearly around 12%. Now, this is an annualized return because we are now in 15 months. So the returns are annualized. The moderate portfolio is up 21%, and the aggressive is up nearly around 30 to 24.4%. So, like as you can see, the beauty of the portfolio is that it is more that the conservative is making lesser money compared to the moderate, and the aggressive is making more money than the moderate portfolio. And the Nifty has given only a 6% return. So, this actually shows the importance of asset allocation more than anything else.
This is wonderful. Like you have beaten the Nifty figures, and also things are falling at the right place. Like conservative, moderate, and aggressive, they all are doing
Yeah.
right job out there.
So little bit of luck and little bit of knowledge. So
Absolutely.
that is required. And investors who are holding the portfolio, I hope they'll also have little bit of patience.
So, what should be an ideal investment period or horizon to invest in each of these portfolios?
Yeah, so when I was looking at the construct, what I looked at is that a person who's a conservative investor, ideally everyone is a conservative investor and everybody wants the maximum return, right? But I think the most important factor in any investment should be what is the time horizon which a person has from an investing perspective. So if somebody is, looking at a 3 to 5 year time horizon, as his goal or whatever he's looking at, then the investor actually should choose a conservative model. If it is anywhere between 4 to 6 years, then I would recommend that he should look at moderate portfolio. And if somebody is looking at aggressive, then ideally he should be having a time horizon which is more than 6 years. And within that, also what happens is that the scheme selection also plays a role. Okay, so in the scheme selection, it also depends upon again on the time horizon. So if somebody will say that his horizon is 6 years, I may still tell him a moderate portfolio, but my scheme selection may be a little bit conservative. If somebody says I'm aggressive and I have a time horizon of more than 10 years, then I can become a little aggressive in the scheme selection. So ultimately, afterwards, this is just a model portfolio. It may not fit each and every person's requirement.
So, adding to this, I have like a personal question to you. If I'm an investor and I want to invest for my child who is now 12, and say after 5 years I would need wealth for his higher education. So, what is that you would suggest? Where do I fit in the model?
So ideally, you would actually fit into the moderate category because your time horizon is 5 years, and the scheme construct would be slightly conservative over there, in the sense that I would give you more of large cap and less of small cap, so that your returns are not very volatile. So, but from a model portfolio perspective, since it is for the education of your child, then ideally it would be the moderate categories where you should actually be.
If one has to do SIP investment, can this model portfolio be followed?
No, ideally, this was for more of a lump sum, and we had just taken a sum of 10 lakhs as a model portfolio. I mean, this will work for lump sum. It could be any amount. It could be 5 lakhs. It could be 20 lakhs, 50 lakhs, right? SIP, it would be a bit different because one needs to understand that, let us say, for example, today, we take your child's example, and you said that your time horizon is 5 years and you want to actually do an SIP. So your investment period would actually only be 2.5 years, because you would start your first installment 5 years back, and one installment would have gone like yesterday. So when you take the average, so whatever is you may say 5 years is 60 months, but your average holding period will only be 2.5 years, and that is the time where most of the people make mistakes out there. So for SIP, this model does not work. In SIP, the conservative model would start with a time horizon only of 5 years, and the moderate could be 10 years, because the average holding period is what you have to ultimately look at.
Lately, there has been a lot of buzz about international funds, But unfortunately, fund houses have stopped subscription in international funds. So, what is your take on it?
So that's a very good question, and this is what many have been asking us, because when we designed the model, we had international funds, but unfortunately, right now the regulation is not allowing most of the funds to collect money, and it's completely exhausted. So the only option which you have is to do a SIP in that. So you will perforce have to do an SIP in an international fund, and still recommend that you should do it, basically for 2 to 3 reasons. One is that it basically gives you an exposure to industries and sectors which are not in India. Hmm. Secondly, it also gives you, a diversification tool. So you are able to diversify in different countries. So you have, China, you have Taiwan, South Korea, US, right? And the third is that it also gives us a natural hedge against the dollar, because the rupee has depreciated, so you are getting a gain also on account of that.
And what should be an ideal, allocation of international funds in the portfolios?
So ideally, first of all, if somebody is starting his journey, first he should look at India. Only when a sizable portfolio has been built up in India, then he should look at diversifying. And if somebody has a, let us say, a portfolio of more than 50 lakhs, then around 10 to 15% exposure to the international funds is also recommended. So I would strongly recommend, is more from a diversification. I'm not looking at the returns which are there currently. Returns will keep on going up and down, but you get a diversification of various industries. We don't have much on AI, semiconductors, so you can get that as a part of your portfolio.
One last question I have, like if someone wants to start with mutual fund investments, so other than, before looking at what scheme to invest in, what is that one has to keep in mind to begin with?
So I think first of foremost, they should actually come to Ventura, and we can actually guide them in terms of their investing journey. But any investment, what you need to look at is that, are you, beating inflation? Okay. Are your returns, tax efficient? Hmm? Thirdly, what is even your time horizon, right? So depending on the time horizon, you need to take appropriate risk, right? So based on that, you need to construct first your asset allocation. Once you have got your asset allocation, the more difficult part comes is the scheme selection, because unfortunately most of the investors are actually chasing returns, right? So you should actually be looking at more at consistency of returns, right? It's like everybody wants to be the top ranker, right? But it's not possible, right? So it is better to be in the top 10, right, rather than being in the bottom 10, right? So don't look for a scheme which is performing the highest. See the level of consistency of the returns, see the fund house, and whether you have to be in which category of that, will ultimately also depend upon the volatility and your time horizon.
Thanks, Juzer. This was really insightful, especially for investors like me and for those who are, still thinking of beginning their investment journey. So thank you so much for this.
It was my pleasure.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully